But the thing that's interesting is that these, with the system under strain, I guess this is why people like Jamie Dimon are saying gold's going higher, and why, Morgan Stanley sort of turn around and say you should, put 20% of your portfolio into gold. Now, that's an extreme statement. A very extreme statement. But I think that the really senior bankers see these dangers. They must be concerned about it. And I think that they would have told the Fed, look, you can't go on tightening like this. We're losing deposits which are going into the general account, and we're not seeing it come out the other side. We are under strain. You carry on this way, you're going to see the same sort of thing we had in September 2019. You may remember when the repo rate suddenly shot up to about 9%, and the Fed had to come in and sort it out. But we're not far from that sort of thing happening. I mean, it is tight, very, very tight. But where does this take us? Well, the thing that's absolutely clear is that if we can look through the top of the credit bubble, when it starts going down, Danny, you will see inevitably the duty, if you like, of the Fed and the US government basically is to keep the show on the road. And how did they do it? They would just accelerate the printing presses. What did they do in Germany in 1922? Accelerated the printing presses. We have exactly the same situation. And on top of that, we can superimpose our lessons from 1929 to 1932. The difference is that in those days, businesses went bust because the dollar was on a gold standard. And the only way in which credit got wiped out was by debtors going bankrupt. And the debtors included something like 10,000 banks. They went bust and didn't honor their deposits. Today, of course, you don't have that. So where is the strain? What happens? How do you reduce the amount of outstanding credit? Well, you don't reduce the amount of outstanding credit, but what you do is you reduce its value. Its value contracts, collapses even. And that's the way in which this is going to work. And the value of credit collapsing starts with the currencies. Currencies will go down. And unless the political class actually wake up to this, and unless their advisors get off all this macroeconomic rubbish and actually begin to apply proper classical economic lessons and inform the politicians of that reality, then there is no way that the fall in the purchasing power of these currencies is going to stop. That's what's required. We've got to go back onto a gold standard, in effect. Do you see that? No, I don't see that. And I certainly don't think that 8,130 tons allegedly in the coffers of the US Treasury are there. I don't think they're there. I think there's a big shortfall. So you've got a credibility problem, which is being well aired, and it's well aired even by people like Scott Bessent. Guess what? As soon as he becomes Treasury Secretary and he gets his feet under the desk in the Treasury Department, what happens? He is told, don't say anything about gold. Stumm, don't talk about it. Why? Well, I can see two reasons why. Firstly, they are in denial about gold because they have been promoting the dollar as gold's substitute, if you like. It's a dollar standard around the world. And the second thing is a lot of that gold, I think, went out. It was leased and never came back. You open Fort Knox, I think someone rather cleverly said, you find a whole bunch of IOUs sitting there. We don't know whether this is really true because, of course, we can only surmise. But intellectually and practically, I think it's going to be extremely difficult for the mighty dollar to if you like, get away from its total collapse. So that's what we face. I mean, this is a very serious time. We are in a sort of, if you like, in an intermediate stage where, the Fed is trying to put some liquidity back into the system because it sees the danger. It's been told the danger by its intelligence in the commercial banking network. That will give us a little bit of relief. It might even puff equities even higher. I don't know. But the only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold. Well, it's impossible to say how long the final collapse of the dollar will happen, and you never know. I may be wrong. You could find that the authorities turn around and actually do something sensible, like secure the value of the dollar somehow. I mean, there may be some sort of fiddle they can do and all the rest of it. I mean, people have been talking about a reset for ages. It's not a reset. It's just to try and secure the value of the dollar. The only way that can be done ultimately is basically by going on to a gold standard. this slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of, seem to have been very successful in terms of, reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. When that happens, basically, you should already be completely out of credit, because the collapse, I think, will be really quite rapid from that point. And they will obviously try and do what they can to stop it and all the rest of it, but it's just going to undermine the purchasing power of the dollar. So in terms of time, I don't think we're far away from the end of the fiat currency system. And the point about being close to the end of the fiat currency system is that we're close to it. Fiat currencies not being there. Now, either they're replaced by something else like a new gold-backed currency or whatever, or they tie it to gold. And incidentally, have to take the economic actions to ensure that it sticks. We're nowhere near that. I don't know. I just sort of feel that we are actually moving more rapidly than we think towards the end game of fiat currency.
Every fiat currency system in history has ended the same way, under the weight of its own debt. The process always begins quietly, in optimism, and ends in denial, with policymakers pretending that printing money is somehow a substitute for productivity. The United States, like every empire before it, is now at that stage. You can feel it. The cracks are widening, and the numbers no longer add up. We've reached the point where the U.S. Treasury is effectively funding itself out of T-bills. That's a polite way of saying short-term IOUs. It's not because policymakers want to, it's because they have no choice. The long end of the bond market is dead. There's no real demand for 10-year or 30-year paper anymore, because investors don't trust that they'll be repaid in money with any value left. So Washington has turned to the short end, constantly rolling over debt, robbing tomorrow to pay for today. That's not debt management, it's desperation. The structure has become inherently unstable. When a government finances itself mostly through T-bills, it's like running a mortgage where you have to refinance every 30 days at a floating rate. The second confidence wavers, the whole thing implodes. In effect, the Treasury is printing money through the back door. T-bills are near-cash instruments. When the government issues hundreds of billions of them to fund spending, it's injecting new liquidity into the system, even if it pretends otherwise. Sure, it's using Federal Reserve dollars on paper, but functionally, it's the same thing as printing. And here's where it gets tricky. When the Treasury delays spending, like during partial government shutdowns or political standoffs, that cash doesn't circulate. It piles up in the Treasury's general account, sucking liquidity out of the private banking system. So you get these strange whipsaws in credit conditions. One week it's tight as a drum, the next week the floodgates open. Add to that quantitative tightening, QT, and you've got a recipe for systemic instability. The Fed's QT program was supposed to reduce liquidity, but it's already dead on arrival. They've quietly stopped shrinking the balance sheet, and soon they'll be forced to reverse course entirely. QE is coming back because there's no other way to keep the system afloat. That's what I mean when I say we're on a credit printing carousel. Every lever they pull leads back to the same destination. More credit, more money, more debasement. They can't stop without collapsing the whole structure. This is eerily similar to Germany in the early 1920s. Back then, the Weimar government faced massive debt from the war, weak tax revenues, and social unrest. Sound familiar? They financed themselves by issuing short-term bills to cover long-term obligations. The currency held up for a while. Then almost overnight, confidence snapped. The mark collapsed, prices exploded, and the middle class was obliterated. We're not there yet, but the pattern is unmistakable. The U.S. is following the same playbook, rolling over unpayable debt, monetizing deficits, and pretending inflation is transitory. It's the largest credit bubble in human history, and the endgame is inevitable. The irony is that the Fed and Treasury will have no choice but to make it worse when the bubble bursts. And it will. The authorities will step in to rescue the system. They'll bail out banks, zombie corporations, and pension funds, all in the name of stability. In doing so, they'll destroy what's left of the dollar's purchasing power. We've already seen the first tremors. The Fed's beige book shows the economy stagnating. Corporate profits are rolling over. Consumer delinquencies are rising. It's all there in the data. just buried beneath layers of spin. The problem is structural. The entire Western financial system is built on leverage. Debt funding, more debt. Margin debt in the U.S. stock market has soared from about $300 billion a decade ago to over $1.1 trillion today. That leverage doesn't exist in a vacuum. It's financing inflated stock valuations, derivatives, and speculative assets that only survive in a world of cheap money. So what happens when that cheap money disappears? Forced liquidation. Banks call in loans, funds sell whatever they can, and markets cascade lower. That's the moment when the credit bubble implodes. We've seen this before. In 1929, the stock market crash wasn't just about speculation. It was the bursting of a global credit boom. Today's setup is even more extreme. We have not just leveraged stocks, but leveraged everything. Real estate, private equity, government bonds, even crypto.
Looking at the DXY breaking 100, it's a race to the bottom. I mean, basically, what of the major currencies, constituents of the DXY, would you buy or sell? It's immaterial. Really what's happening is that the whole of the fiat currency system is coming to an end. And we're seeing evidence of this. Every fiat currency system comes to an end because of the accumulation of debt. And that's basically what we have at the moment, Danny. It's got to the point where it's not sustainable. If you look at what the US Treasury is doing, it's funding itself out of T-bills. It really is. The problem is there's no market on the long end of the yield curve. So they can't actually go out and replace maturing long-dated stock with more long-dated stock. In other words, ensuring that the annual rollover, if you like, of debt is contained. No, they're replacing long-dated with T-bills. I mean, that's where the market is. But what it does mean is, in effect, the US Treasury is printing money. I know it's using Fed dollars for it, but it's printing money because T-bills are near cash. If the other side of the balance sheet is near cash, then you can see what's happening. It's leading to a certain amount of liquidity problems because if the government, if the Treasury doesn't spend this money, and at the moment, the major parts of the government are suspended, then it accumulates in the general account. So it goes out of circulation. So it doesn't go back into bank balance sheets, if you like. Mm-hmm. So on that basis, you can see that, this is tightening the system. On top of that, we had QT, which was also tightening the system. And this is why the Fed has stopped doing QT and will reintroduce from this month, next month, whenever, quantitative easing. But that again is printing money. So, we're on a printing credit roundabout now. How else can we print it? Well, let's find another way of doing it. That's where they are. And this is roughly where Germany was, I think, in the very early 20s, 21, early 22. And we know what then happened. And we can see how it's going to happen here too, because when the credit bubble bursts, and the credit bubble will burst, this is the biggest credit bubble in history. And on top of that, it's looking so much like 1929 with Trump's tariffs on top, replicating Smoot-Hawley and all the rest of it. When it bursts, what it's going to mean is that the Fed and the Treasury will stand by to rescue the entire banking system and also all the major zombie corporations in the US economy. They have to do it because the unemployment mandate, if you like. And of course, the Fed is also seeing in its beige book signs that the economy is falling over, toppling, if you like, stagnating, however you like to put it, turning down. So this is a time of maximum risk. Now, at the moment, I don't think that the stock market really realizes this, but there will come a point when it does. But for now, I think with extra QE coming in, the tightness in credit markets being alleviated, it could well feed into yet higher equities in the very short term.
So where does this go next? The script is already written. Every fiat currency system in history ends the same way, with too much debt, too much money creation, and too little trust. What we're watching now is not just an American problem, it's a global one. The dollar, the euro, the yen, they're all in the same sinking boat. The only question is who hits the water first. The US dollar still looks strong on the surface, but that's only because everything else is weaker. The DXY measures the dollar against other fiat currencies, the same sick patients in different stages of the same disease. Against gold, the dollar has already lost over 80% of its purchasing power. Since 2000, against energy, housing, or food, it's even worse. So yes, the dollar may win the race to the bottom, but that's hardly victory. It's just the last one to drown. The next major event will likely be a credit market rupture, something that exposes the fragility of the system. Maybe it's a failed treasury auction. Maybe it's a sudden liquidity freeze in repo markets. Maybe it's a blow-up in the shadow banking system or corporate bond market. But the spark almost doesn't matter. The tinder is already dry. When that happens, the Fed will panic. They'll reopen QE on a scale we've never seen. Trillions more in printed money, justified as temporary emergency liquidity. It will save the financial markets for a while, but at the cost of the currency's credibility. We saw this movie in miniature during the 2019 repo crisis, then in 2020 during the pandemic. Each time, the balance sheet expanded to stabilize markets, but once you normalize intervention, markets stop functioning on their own. They become dependent on stimulus like a junkie chasing the next fix. That's where we are now. The stock market isn't rising because the economy is strong. It's rising because traders know the Fed will always blink. The system has lost the ability to self-correct. At some point, that moral hazard becomes fatal. When every investor knows the central bank will print to prevent losses, the only rational strategy is to take more risk. That's why margin debt is at record highs. That's why speculative bubbles form in everything from AI stocks to meme coins. The system rewards recklessness and punishes prudence. And yet, the laws of economics haven't been repealed. Debt can't grow faster than income forever. You can't inflate your way to prosperity indefinitely. When the debt pyramid finally collapses, the unwind will be brutal. The first casualties will be the over-leveraged institutions, hedge funds, regional banks, and zombie corporations. Then will come the pensions, the insurance companies, and finally the governments themselves. Because when tax revenues fall and interest expenses soar, there's no escape hatch left except monetization. That's when the public wakes up. Prices will rise faster than wages, savings will evaporate, the middle class will revolt, and confidence will collapse. Not just in policymakers, but in money itself. We've been here before. Weimar Germany, the Latin American debt crises, the Asian financial crisis. Each time it starts with denial, followed by inflation, then panic. Now some people think Bitcoin will replace the system. I don't. Bitcoin will not become the new reserve currency. It's too volatile, too speculative, and too dependent on the same credit conditions it claims to replace. When liquidity dries up, Bitcoin falls, not rises. That's not a store of value. That's a risk asset in disguise. Gold, on the other hand, has no counterparty risk. It's the only monetary asset that isn't someone else's liability. That's why central banks are buying it at record levels. They know what's coming. They may not say it out loud, but their actions speak volumes. China, Russia, India, and even smaller nations are quietly accumulating gold because they understand that trust, not technology, is the foundation of money. When fiat trust dies, gold reemerges as the anchor. That's the real reason the BRICS alliance has been discussing settlement systems tied to commodities and gold. They're not building a new currency. They're building a hedge against the collapse of the existing one. Meanwhile, in the West, policymakers are still in denial. They think they can manage the transition by introducing central bank digital currencies, CBDCs. But digital money built on the same fiat foundation isn't reform, it's surveillance. It gives governments even more control over a system that's already failing. The irony is that while they're building digital prisons, the rest of the world is building vaults. The East is accumulating metal, while the West accumulates code. When the next credit crash hits, the difference between those two strategies will become painfully clear. So what should ordinary people do? The answer is simple but uncomfortable. Stop thinking in fiat. Stop measuring your wealth in dollars, euros, or yen. Start thinking in real terms, what your money can actually buy, not what the number says on a screen. Own real assets. Precious metals, productive land, energy, and essential commodities. Things that can't be printed, because when the system resets, and it will, those who hold real assets will emerge on the other side with purchasing power intact. Everyone else will be left holding paper promises. And don't be fooled by short-term rallies in the stock market or crypto markets. Those are just the death throes of a system trying to keep people distracted. Every major hyperinflationary episode in history was preceded by a stock market boom. The Reichsmark collapsed in 1923, but the Berlin Stock Exchange hit record highs, first nominal gains, real losses. That's where we are now. Stocks may rise, but in real terms, they're sinking. You can't print prosperity, you can only print illusions. The end of this fiat experiment won't be a single dramatic event. It'll be a series of rolling crises, bank failures, liquidity freezes, inflation shocks, culminating in the loss of faith in central banking itself. When that happens, gold will not spike, it will reprice. The world will rediscover what real money looks like. This transition will be painful, but its necessary. Fiat currency was an experiment, a long, seductive one. But it's over. We're entering the era of accountability. The question now isn't if the system changes, but how gracefully it does. If we're lucky, we'll see an orderly revaluation, perhaps even a partial gold backing to restore confidence. If we're not, we'll see chaos before reconstruction. Either way, the outcome is the same. The end of unbacked fiat as the foundation of global trade. So prepare accordingly. The world is moving back to real value, and those who move with it will thrive. Those who don't will wonder, years from now, how they could have missed the most predictable collapse in financial history. The fiat era is ending. The age of tangible money is coming back.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.